There was a small but noticeable fall in the Australian dollar after the ABS released its latest Consumer Price Index, or CPI, which showed inflation was not as high or as bad as people were expecting. So whether you're looking at the annual headline rate, which is 3.8%, or the underlying rate of 3.6%, which is when you ignore volatile electricity and fuel prices, inflation is still way too high. But the Aussie dollar slipped to 69.5 US cents because markets now reckon those not as terrible but still quite bad inflation figures will give the Reserve Bank some breathing space at its next meeting in 2 weeks' time. So the market pricing for an August rate rise fell from 19% to just 2%. And the likelihood for February next year dropped from 92 to 52%. But there are some economists who say markets are underestimating the odds of a further rate increase, especially when you consider housing costs, especially construction, electricity and rent, are still very high. And there's a decent chance transport costs, namely diesel and petrol, will see a significant increase once the government's fuel excise discount ends on Sunday. And those things have often been big drivers of inflation. Meanwhile, the Australian share market went up sharply for its third day in a row. Rio Tinto was one of today's best performing stocks after the miner announced its biggest half-year profit and dividend in years, partly due to a boom in copper and the global trend towards electrification. And ongoing concerns about overvalued AI and semiconductor stocks led to another sell-off across Wall Street and South Korea in particular. And oil prices have risen sharply again after yet another flare-up in US and Iran hostilities. And that's finance.